Okay, good afternoon, everyone. Thank you for joining us. We're ready to get started with our free webinar, The Economics of the Coronavirus. Is it different this time? If someone could just reply back in the questions, make sure you can hear me. I'd appreciate that. Just have a couple of slides to go through quickly before we get on with the presentation. First, our disclaimer. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or a recommendation to buy, sell, or hold any security or contract. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific trading strategies. Security, derivative, and futures trading involves a substantial risk of loss and is not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed is a division of Lime Brokerage LLC. Lime Brokerage LLC is not affiliated with these third-party market commentators, educators, or service providers. Data, information, and material are provided for informational and educational purposes only. This content neither is nor should be construed as an offer, solicitation, or recommendation to buy or sell any securities or contracts. Any investment decisions made by the user through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lime Brokerage LLC does not endorse, offer, nor recommend any of the service or commentary provided by any of the market commentators, educators, or service providers, and any information used to execute any trading strategies are solely based on the independent analysis of the user. Okay, so my name is Joe Ely. I'm a registered rep here at Lightspeed. For more information on a demo of our trading software, or if you're interested in opening an account with Lightspeed, you can contact me. My email is jely@limebrokerage.com. At the end of the event, we'll have a drawing. One lucky attendee of this webinar will be randomly selected to win a Lime duffel bag. If for some reason I forget to do that at the end, if someone wants to post a question there asking me or reminding me, I'd appreciate that. I have been known to forget every once in a while. The economists, Mark and Bill, and I'm just going to read through this quickly because I think both Mark and Bill, have earned everything that's written here.
I don't think you have to read the whole thing, Joel.
Yeah, I don't know. We'll just do it really quickly. Mark Shug is professor emeritus at the University of Wisconsin-Milwaukee, where he directed the Center for Economic Education. He taught for 36 years. If you want to read that entire bio, that'd be great, because he does have some significant accomplishments. Same with William C. Wood. William is a professor of economics and director of the Center for Economic Education at James Madison University. He was the recipient of teaching awards at the University of Michigan and James Madison University. And again, I encourage you to read his credentials there. With that, I am going to turn the presentation over to Mark. It's going to take just a second or two here, and we'll get on with the presentation.
So you tell me, Joe, do you want me to click on my slides?
1 second, I have to make you the presenter and then do so. Yes, 1 second.
And there we go. Everybody see that okay? Or Joe, can you see that okay? And Bill?
I do, yes, it looks good.
All right. Oh, here we go. The economics of the coronavirus. Oh my Lord, is it different this time? It's been quite a rock and roll day, and events have been changing by the minute. But let me tell you what Bill and I are thinking about doing. We'll do a little bit on the latest news of the coronavirus. As I say, there's already been a lot of news today, and we'll try to update some of that. What can we learn from earlier outbreaks? We'll spend a little time talking about things like the Spanish flu and SARS. And then what do economic tools tell us about the outbreak? So we're going to talk about monetary policy and also a little bit about fiscal policy and other government policies that people are talking about right now. And maybe most relevant to the group now is what is next for the markets, a market that dropped to 21,000 today. A pretty substantial gain for a drop from where it was at 29,000 just a short time ago, 29,500 about. And then Joe will be monitoring the questions and be sending them our way. So let's go. Well, the Centers for Disease Control is the flagship operation at the federal government, and they're responding to this outbreak of the disease that is now called the coronavirus. It was first detected in China, and I just checked the website before we went live here, and it is still saying 100 locations internationally, including the United States. So 100 locations around the country, around the world. It's called the virus has been named SARS-CoV-2, and we've been calling it coronavirus disease 2019, and now it's COVID-19. Health and Human Services declared a public health emergency back in January, but yesterday the World Health Organization declared it a pandemic. It's just speculation on my part, but I think they're holding off just to see what was going to happen here. And now that it's spread to so many countries, I think they feel pretty confident calling it a pandemic. This is sort of interesting. I'm basing a lot of this from Wall Street Journal reports. China apparently was slow to respond to this. It appears some politics got involved. The first case, as many of us have read in the news, and there's some controversy about this. I'd heard of a variety of reports. The research from the Wall Street Journal suggests that there's a live market in Wuhan. That means it's got live chickens and pigs and things like that. That the first case was reported on December 10th of 2019. It took a while for the doctors to understand what was going on. They quarantined patients, but they were prevented specifically from party leaders from alerting other doctors and the public. I'm sure they didn't want to engender a panic, but it appears that President Xi Jinping was leading the response at that time. When Wuhan went ahead with its New Year's celebrations, and then separately or shortly after that, 5 million people left Wuhan without any screening. And so this just released all kinds of folks to go back to their homes, and many of them in turn visiting other countries. So Wuhan is not placed under quarantine until January 23rd of 2020. So that previous slide, it's first detected December 10th. Actions don't really start to happen until 6 weeks later. Early on, doctors they weren't 100% sure, but once they realized it was spreading from person to person, there was hesitation on the part of the Chinese to let that word get out, and thus this graph, which is a very impressive graph of how things started and where they went. And you can see there that, here back in early December, you can see not much going on. And then here by January 9th, they announced the outbreak. And then you can see how quickly it all changed after that. So pretty dramatic change of activity here in China. Let me get back on this. Okay, there we go. Now this is the map, and you can find this. I recommend really everybody should go visit the Centers for Disease Control. But this is the map that they're showing on their website that's identifying these 100 different locations around the world that's infected. But this really isn't such a, I find this to be very crude. It's like, if you look at the United States, you could have 300 people infected and the whole country is darkened. That doesn't give the real nature of it. There are pockets of infection around the United States. It's not like everybody in the country has it. So I found this map from Johns Hopkins University. It was down for a while this morning, but it's back up now. I imagine it was just overwhelmed, but this is a much more realistic picture. So this shows the rapid outbreak in Asia. And then I put little red arrows here to sort of indicate this. And so here you can see the outbreak in Asia. Here you can see the Middle East. This is largely Iran. And now we see Europe. And up till right now, this is largely Italy. But Germany is thinking that things are changing very quickly there. And you can see, yes, there are cases in South America, but not as dramatic yet. Yes, there are cases in North America. But you see, this is the bad news up here in Seattle and some other places in the East Coast. We've had a couple. I'm in Florida. We've had a couple cases down here. So that gives you a pretty good idea of what's going on. And so this was the case yesterday, 121,000 total confirmed cases, with China leading the pack at well over 80,000. That number today is 127,000, almost 128,000. Deaths yesterday were 4,300. Today they're 4,700. Recovered was 66, now 68,000. And so you can get a little sense of what's going on in terms of this. This is far from over yet. On the other hand, the same website shows this. So this is still at Johns Hopkins website, and you can see the flattening that's taking place. This is mainland China now. So you can see that it's peaked and it's flattening out, and so probably not long before it starts to come down. This is the rest of the world. And so that's still on the uptick. So this would be Europe and the United States. And here you see the recovery rate. And so you see the recoveries are also getting better. So Bill, talk to us about scenarios.
Yeah, scenarios are important when we've got uncertainty. The first scenario is that the virus is contained through public health efforts, China, South Korea, Japan, Italy, Iran, wherever else it crops up. And this scenario is still plausible because although media reports tend to be very pessimistic, there is active containment going on in all the places where this has appeared. In this first scenario, the rather optimistic one, it would nonetheless mean rolling disruptions to economies for months. So that's the first scenario, the optimistic one. The second scenario is that despite all public health efforts to contain it, this virus continues to spread. And if this occurs, then we could knock points off of the global and the domestic GDP. We'll do a little bit of calculating, but the big problem here is not that the most likely outcome is bad. When we look at a distribution of the severity of the outbreak, most of the possibilities are somewhere in the middle, based on past viruses, based on the epidemiological characteristics of this one compared with the others. The most likely outcome is not really that bad. The problem that we give the colorful name tail risk. And the big problem is the chance of our second scenario occurring in which these containment efforts are ineffective. And you look at just the little blue tails of the distribution there, those little blue tails are rather unlikely but very severe outcomes. And so the tail risk is what we're worried about. Now, analysis such as what Mark and I are doing today can seem heartless. And there's our little, heart symbol there. Individual deaths are just part of a statistic, but they change the course of real families and futures. And in the case of my own extended family, my grandfather-in-law was a victim of the Spanish flu. He was struck down in a matter of days when he was young and healthy. It is a family story. It made my grandmother-in-law a widow at a very young age, and she moved into the spare room off the kitchen in the family farmhouse, and it changed the course of that family, making them both poorer materially and poorer in not having the contribution of my grandfather-in-law. Now, we don't think that money and wealth are the most important things in the world. And therefore, we just wanted to point this out because when you start doing the analysis and listening to the news, you will hear people say things like only a few thousand deaths. Well, to the families involved, those are life-changing. So we don't mean to be heartless, but we do want to provide the guidance that we think economic theory and analysis can provide.
Okay, Bill, thank you very much. Well, let's talk a little bit about some of the past outbreaks. Here's the most recent, or one of the most recent anyway, SARS epidemic of 2002. It had a fatality rate of 10%, which is very high. The current coronavirus is estimated to be around, I've heard different numbers, but this is from the CDC, of 2.3%. And while SARS was scary, it was controlled fairly quickly, mainly due to the stuff that people are doing all over the place now. Maybe avoiding large crowds, but mainly washing your hands and following those sorts of measures. And people who contracted SARS showed severe symptoms early on, and that's been one of the problems with coronavirus. Is it's harder to detect. People can have it and not realize they have it, and therefore they don't isolate themselves soon enough. The symptoms might not appear for days. They've been talking about 14 days, but I've heard some higher than that. And then we have the chart showing here that coronavirus, the death toll has already overtaken SARS. So there's it's something to worry about here. Now suddenly I've been noticing hits on websites talking about the Spanish flu epidemic. Suddenly, the Spanish flu epidemic of 1918 that Bill was just talking about is very much in the news. It was clearly a pandemic. It was the worst pandemic in recent history. Imagine this, it surpassed all the military deaths in World War I and World War II combined. I mean, just try to get that under control. And if you do a little Google search here, to kind of put things in perspective, life was a lot different in 1918. And the United States is listed as one of the places where it may have started. I believe the first outbreak was in Kansas, and it was a military camp, but it's suspected that it came, like many of these viruses, from contact with pigs or swine, and it spread that way. But the research on this, all these years later, is still not clear. It could well have been a military base in Kansas where the first outbreak was, but the researchers also think France, China, or even the United Kingdom may have been the source. This affected 500 million people. 500 million people, and 50 million people died. Over 500,000, I think it's around 600, north of 600,000 people in the United States died. So, a little perspective, this was a real disaster. It had a lower fatality rate in that a lot of number of people that got it survived. But now, why this really looks different is that we're all so connected now. Like I was commenting with all the people leaving Wuhan, with jet travel and tourism and all these complex supply chains. This one does look different than some of the earlier outbreaks we've seen. So Bill and I are going to talk a little bit about the economics of the coronavirus. And so here we go. We are already seeing this. If the virus spreads a lot in the US, people will miss work, cancel travel, and avoid others. I've got 2 national conferences in the works this month. This month and early next month, and I'm getting daily announcements that they're going to cancel. I just heard the NBA is going to be canceling. The National Hockey League is canceling. Spring training is canceling. So that even if the virus hasn't spread at a radical rate, it does appear that people are that many organizations are making sure that we avoid each other. And of course, then a lot of businesses, now we don't want to go crazy here, but it does appear that a lot of businesses, colleges, higher ed institutions, other kinds of nonprofits are going to be affected. The most obvious ones are airlines. President Trump announced last night that he's going to shut down travel to Europe, not counting the United Kingdom. Americans will still be able to travel back and will be able to travel, and people with green cards. But clearly the airlines are going to have already been affected and now are going to be affected more. And then the travel industry more generally, we've been hearing a lot about the cruise industry, the hotel industry, the restaurant industry, because people are not going to want to gather so much, and the automobile industry. I'll develop that a little bit, and there's way more to talk about. We're going to talk about steel and oil here in a second. Automobiles, it turns out that a lot of our parts come from China, and while China seems to be recovering and it's trying to reopen its facilities. There's already some impact in South Korea and Japan. I haven't heard any reports yet in North America, but that is clearly a possibility. Pharmaceuticals are a problem. There's some evidence of shortages already in India. We've heard now, suddenly we've discovered, I mean, who knew that all these antibiotics are produced in China? And so apparently we don't have a backlog or a backup storage like we do with oil of these older antibiotics in the United States. So that's problematic. Apple is in big trouble. They made a very conscious business decision that they're going to concentrate the assembling of their products in China. This was a little controversial on the members of their board and their administration. And now we see that much of the factory production has been shut down because of the coronavirus outbreak. As of March 3, so long ago, Apple's market value had declined by more than 100 billion. And it's hard for Apple to leave. I mean, that's why they stayed, is that they require such a large labor force that they didn't think places like Vietnam could accommodate them. Steel, really kind of a similar story. China's a world top producer of and consumer of steel. China's been on a building spree for several years. So China's demand for steel is going down, but many of the nation's steel and aluminum mills have continued to operate. So prices are plummeting in steel. And so here's just classic. Here, orders are down. So you see on my pile up graph, then inventories are building up, and you know I know something about supply and demand, and so now you know the prices in the steel industry are collapsing. Same story in oil, but this isn't exactly, well, it's sort of an unintended consequence, like any of this is intended, but a secondary effect maybe of on oil. Saudi Arabia wanted to reduce its production due to the slowing demand in China because of the coronavirus. And it had reached out to its ally. The two of them had been working together for months, that is Russia and Saudi Arabia, to try and cooperate. But Russia, they both Saudi Arabia and Russia are very dependent on revenue from oil. Russia said they're not going to reduce production. And now just the opposite is going to happen. Both are planning to pump and pump. And so this seems like it's great for consumers, and it is. I see my local oil prices drop, or prices at the pump are declining right in front of my eyes. But the downside is for the U.S. shale producers, and if those folks risk going bankrupt. So you can see what's happening to Brent crude oil futures prices in our graph there. But in a different sort of way too. The United States has pretty strong capital markets, and the Federal Reserve is standing by to step in if we wind up with some kind of liquidity crisis in our banks. So I'm going to just kind of go out on a limb here and suggest that while Russia and Saudi Arabia are sort of eating each other alive, it's going to be a tough ride for U.S. shale. But at the end of the day, U.S. shale might be the ultimate survivor in this, but we'll see what happens. And here you see what's happening. So this is a graph. So up here, you're seeing oil production from Saudi crude oil production, and what they're talking about going is up here. Okay, so they're talking about pulling all the stops out to head up here. So that helps explain that slide there about what looks to be happening that way. Monetary policy. So the Fed has gotten itself involved, and it started to act fairly quickly. So the Federal Reserve acted quickly to lower interest rates 50 basis points on Tuesday, March 3, setting the target at 1% to 1.25%. But I think many economists would say here the Fed does not have a lot of room to move. The Fed's target range on this is called the overnight rate. That's what that negative 50 basis point was targeting. It's called the overnight rate, or the federal funds rate, was 1.5% to 1.75%. Now it's 1% to 1.25%. But back in 2007, at the beginnings of the Great Recession, it was 4.25%. And so you see, that was still a relatively low rate, but that was a kind of a normal rate. So you see where the Fed is starting right now, 1% to 1.25%, interest rates, there's just not a lot of space to go. And here this graph sort of shows you that they had started to raise, of course, and this had President Trump howling at our buddy here, Jerome Powell, who's president of the Federal Reserve Board. And I know the president was upset about that, but then they started to come down, and this is where we're headed right now. So this, like I say, that's not a lot of room right here. It wouldn't take a lot, and you would turn negative. Jerome Powell said a rate cut will not reduce the rate of infection. It won't fix a broken supply chain. We get that, but we do believe that our action will provide a meaningful boost to the economy. There's some truth to that. Typically, the Fed lowers when it fears an economic slowdown is coming, but usually that's a result of a normal business cycle. We're anticipating a recession. We're seeing consumption decline, for example. Maybe we're seeing investment decline, or in reaction to an economic shock. And now we can say, well, there's an economic shock, and the oil prices, that looks like a pretty serious economic shock. Back, of course, in the 1970s, the economic shock we saw was in just the opposite direction, where oil prices went through the roof. So the idea that lower interest rates will encourage businesses and consumers to borrow more and spend more, I mean, when you're trying to increase, Bill's going to talk about GDP in a minute, but that's I and C. Business spending is I and consumer spending is C in GDP. And so they're hoping those lower interest rates can do it. But of course, as Jay Powell said, interest rates can't fight a public health crisis like a virus directly. That requires public health measures like washing your hands. Lower interest rates don't address supply chains and problems in China and elsewhere. But, the easing rates might help, as Jerome Powell said. Companies that are experiencing these supply chain problems might be able to borrow funds at a lower rate to stay open, make payroll, get through this. Consumers also would have an easier time borrowing money to meet their existing obligations. And so the lower interest rate would help them. But overall, I think the impact of the lower interest rate seems kind of weak, a little bit off to the side. And now, even more recently, now the Fed has been talking about the need to step in as the lender of last resort, much like it did in 2008. So just one angle on this is that transactions in the production supply zones in Asia are denominated in US dollars. So it's possible, because of this turndown, that Japan, Korea, Taiwan, China, and Hong Kong are going to be requiring more dollars. And so the financial supply chain eventually leads to the United States. And that may mean these banks are going to need an injection of liquidity from the Fed itself. Now, that doesn't mean just throwing money at this. That, liquidity funds will come, and they might come at a discounted rate, meaning the interest rate is paid in advance, or and certainly they will come with collateral being put up. But nonetheless, the Fed may need to step in. It may run through helping domestic banks, which then in turn help these other banks. And already the Fed is pumping money into US money market funds, and it has been doing that for a few months, which show some liquidity problems, meaning there's nothing wrong with the money market funds. They're just running a little short of cash, and they need a little liquidity to get through this immediate problem. Not unlike the situation in It's a Beautiful Life, when Jimmy Stewart's savings loan was running out of cash. The savings and loan itself was solvent. They just had everybody taking their money out of the accounts, and they just needed to get through that short-term crisis. So the declines in the financial markets may encourage the Fed to revisit. So it may even go past that and look at some of the other moves it did in 2008. It might expand short-term lending to banks to keep plenty of liquidity in the system. That could take a variety of forms. It could take the old-fashioned form of discount loans as we did in 2008. Could also, there's now this whole, we're not going to get into this big repo thing, but there are ways that they can do these very smooth transactions through repo transactions where the Fed takes bonds, treasuries, and so forth out of the banking system and replenishes it with cash that can be become loanable funds to keep everything moving along. I haven't heard too much of this, but there might even be some return to the days of quantitative easing. I don't think anybody's ready to talk about that yet, but just to get that out on the radar. And so the Trump administration, of course, has been proposing just the other night to suspend payroll taxes, to assist workers who don't have sick leave, to defer taxes on small and medium businesses. Congress is working on its own package. So there may be a variety of other policies out there. There's some other things that could happen. It's not being talked about very much, but the U.S. could immediately lift unilateral tariffs on China and elsewhere. I mean, we've imposed these at a very different point. They could be removed for a period of time, and that would certainly ease a lot of the stress around the country. It's not going to change supply lines overnight, but it certainly would give an incentive for businesses to be able to get back in line quickly. Some economists are saying this is the time for infrastructure spending. Others are worried about all the spending we're taking on right now and the fact the deficit is so high already. But nonetheless, that's out there, as is this suggestion for a one-time payment of $1,000 to each adult citizen and $500 for each child in the United States. So there's still a variety of other macro kind of measures and international trade measures that can be put on the table if we see that second scenario that Bill talked about unraveling or taking effect, I should say. So what do you think, Bill? What should we be thinking about in the financial markets?
Well, a lot depends on that successful containment strategy, Mark. That's what it all depends on. The OECD, the Organization for Economic Cooperation and Development, a Paris-based organization, has great data sources. If you're doing your own research, great place to go to see what's happening. Their forecast is that global growth will weaken because of the coronavirus, but it's a relatively optimistic forecast, the last one that we saw. Notice the estimate that the global economy will grow at 2.4%, down from 2.9%. That's 0.5% in growth rate off of the world's major economies. And while, that's a lot in a way, it's just another disturbance. And if you look at it from the standpoint of the Chinese economy, that OECD estimate is that China would still grow at 4.9%, despite being the epicenter of the outbreak. Now, that would be down from 5.7. So you notice that amounts to an assumption that containment will succeed. And as we'll see, it's not really a crazy assumption. And if you look at it on a graph there, you can see China, which has been leading the world in growth, falls back a little bit there on the bar. The G20 countries don't look so bad. Italy is perhaps in a good deal of trouble with weak GDP growth to begin with, and then large impact from the virus there. But what we're really most concerned about is the United States. Now, there's the US GDP, and you can see from Federal Reserve data there, the steep decline that our GDP growth took in the 2008 Great Recession, but how the economy did recover. Now, it's important, I think, to go back to the formula for GDP to understand why a relatively optimistic scenario isn't crazy. The biggest component of GDP is consumption, consumer spending. And remember, it's calculated annually. So that means if we have a period of a couple of weeks or even a couple of months in which consumption falls because people are sheltering in place, then that leaves room for a surge of consumption spending when everybody feels that it's safe to go out again. In another way, too, consumption, sure, people are spending less on some things, and some sectors are very hard hit. But if people spend it somewhere else, then aggregate demand doesn't collapse. It hurts some sectors and helps some others if that happens. The same thing for business investment in plant and equipment, the second component of GDP. If it shifts from one sector of investment to another, then it doesn't collapse. If it shifts across time so that there's less in the second quarter of this year, but more in the third and fourth quarters, it doesn't collapse. Now, government spending will go up some as a result of this virus. And net exports are certainly being hurt, international trade in all levels. But being at about 2.5% with a relatively optimistic containment scenario, it really might not be that bad on US GDP. So we academics do have a cloudy crystal ball. It's not crystal clear showing us exactly what's going to happen. But what we find is that we can do two things. We can fit data from the past. And the way we do this is to show what the economy did and then construct a speculative model that's back-fitted, it's backward looking, that shows what we think the economy would have done in the absence of one of these disease outbreaks. And the academic research literature on this is showing that SARS, as bad as it was from a medical standpoint, had a much smaller than predicted impact on the GDP. We here at James Madison University have this weekly macro seminar where macroeconomists look at some of the latest research, and our most recent set of papers was on this. That first approach has the benefit of being validated from the past. The other thing we can do is to model the future. And when we model the future, we're being a little more speculative, but what we're doing is constructing a model of the economy and then disturbing some of the assumptions to show losses that come about from deferred or canceled spending and other things like that. And from novel forms of influenza, what we've had before are one-time GDP losses of 0.5% to 2%. And those are one-time losses. It's not that the GDP growth rate was depressed forever. It is rather that for one time, for the duration of the episode, we lost 0.5% to 2% of GDP growth in a year. So if we took this estimate straight over, we could have a small slowdown, like if we just lost 0.5%, or we could have a year of zero GDP growth. And just to see what the possibilities are, I did a little calculation. What would a year of zero GDP growth be like? How bad could a no growth year be? Well, the mean estimated effect when you run these calculations over the past 10 years, if you have a 2.5% reduction in real GDP growth for 1 year, that loss is about 5,000. The point estimate there is 5,066 points in the Dow Jones Industrial Average. Well, folks, we got that Monday, going from 29,000 to down around 24 somewhere. And I will say, for my part, that made me a buyer. We were joking around before we got going. I want to buy all the way down because I am an optimist about the future of the U.S. economy. Not that that's an investment recommendation. But to me, the more important point about this Dow calculation was not the mean effect of negative 5,000. It's how big the uncertainty is when we have a no growth year of GDP. The effect could easily be minus 11,000. Now let's see, how far would that take us down? It would take us down to 18. We're almost in reach of 18 now with another bad day like today, at which point I'm really optimistic on stocks that get beaten down 11,000 Dow points. But the uncertainty is so huge, it could be as negative 11,000, or we could even have a positive plus 1,094 there. That's saying with a zero growth year in GDP, we could have a 30,000 Dow again. And what I would stress here is not only are those effects possible, even with the assumption of this back of the envelope calculation, there's a 2.5% probability it would be worse than 11,000. And there's a 2.5% probability that it would be better than plus 1,000. So when I did this slide, how bad could a no growth year be? I put an asterisk there. And the asterisk is where, mentioned at the start of the webinar here, past performance does not guarantee future results. These estimates were from a regression analysis of quarterly data on real GDP growth and the Dow Jones Industrial Average. So this is definitely the back of the envelope. You see the back of the envelope there. And I would stress that in a lot of different ways, the back of the envelope understates the uncertainties. If I were teaching my econometrics class right now, I could ask an essay question and ask my students, what's wrong with that back of the envelope calculation we just did? And I would expect them to have multiple points about why that calculation understates the uncertainties. So that's the asterisk.
Okay, Bill, thank you. Just a quick tale. Bill has already alluded to this by saying he's buying all the way, it goes all the way down because he's ultimately optimistic about the U.S. economy. Just to cycle back to 2008, U.S. Treasury was Hank Paulson, I think. Federal Reserve Board was headed up by Ben Bernanke, and they were genuinely panicked is too much, but they believed they were up against that the economy was about to experience a financial collapse. And so there's no doubt that they were extremely worried. They were meeting in each other's offices. They just felt the financial world was on their shoulders. And there, the Dow fell from 14,000 to 6,600. I remember living through this. This was just, I saw. I'm a little older than most of the people listening, and I'm approaching retirement, not quite there, but I'm watching half of my savings go away. 12 years later, Dow Jones Industrial Average almost touches 30,000. So people that held in there, the buy and hold investors were rewarded by hanging in there. The dollar cost average. The dollar cost averaging investors also benefited because I was one of them. I was buying throughout this whole period. I admit I wasn't reading all my statements every time, but I was in the market kind of like Bill was saying. I was buying all the way down, but then I was buying all the way up. Yeah, but there's a few sleepless nights in there. So investors who sold in the declining market lost out, and I have a lot of friends that sold. I thought some people sold because they were sort of panicked and wanted to cut their losses. I get that. Others sold because they were a little older. They're approaching retirement, and they're not at all sure they've got the time frame to wait around. It did take a long time for the Dow Jones to come all the way back, and so that's also a point. So what might be a smart strategy today? Well, that's obviously something that you have to think about. But as we've been saying, well, I think one of the sayings on Wall Street is buy on the dip. And boy, have we seen the dips. So perhaps now is a good time to buy. I know a lot of people came in the other day back into the tech sector because they thought that it had really been beaten down way too far. Way too early, that maybe it has a ways to go yet, and maybe you don't want to get serious about it. Or, of course, depending on your investing goals and your ability to sleep at night, is now the time to bail. Bill, do you want to comment on any of this 2008 investing tale?
Yeah, just two things. I told my students in 2008 that when the market did that, I slept like a baby. And by that, I meant, well, I cried and I kicked the covers off. It was a tough time, but this is actually the very week in March that the market bottomed out in 2008. And I wasn't smart enough to make a really good move in 2008 and put a bunch of money in that market, but I put some in because twice every month, without fail, I was putting money into the market. And although I didn't have the bravery to put it in then, I did have enough inertia to just let it keep going in, and those are very smart dollars. And I'm hoping, along with many of our listeners, I'm sure, that dollars that go into the market this week will look very good from the standpoint of not too long from now.
And then we're just gonna invoke all those things that Joe just said earlier at the disclaimer. And I know that we're not, we're not financial advisors. We're just economists. But Joe had all those disclaimers early on. But anyway, we're just sharing a little bit of our experiences. So, well, there's a lot of unknowns, and we certainly have stressed that regarding the coronavirus. In some ways, it looks more dangerous than past outbreaks. A widespread outbreak certainly that we're seeing right now. Although widespread is an interesting word. A widespread outbreak certainly could cause people not to go out and to avoid others. But like I say, we're seeing now a lot, a large number of cancellations. Some sectors are going to be hurt more than others for sure. We're seeing it in oil and steel. We're certainly seeing it in airlines and travel, restaurants and that kind of thing, and international trade issues as well. Disruptions in supply chains will almost certainly have impacts, perhaps knocking a few points off global and domestic GDP, depending on the severity of things. And we're seeing the politicians hop around a lot. And some of those policies seem more reasonable than others, but that's for you to decide. But nonetheless, the Fed and Congress and the president have been talking about a number of actions. And some of those, I think, are very obvious. Are obvious might be too strong, but are almost certainly things we're going to be moving toward. So, Joe, have we got any questions? Well, hey, if you have some, if you'd like a copy of the slides, there's my email, mschug@UWM, that's University of Wisconsin, Milwaukee.edu. And here's Bill Wood, WC, at James Madison University, jmu.edu. So, feel free if you want to jot that down. After our last webinar, I had a few people get in touch. A couple of people had questions. A couple of people want a copy of the slides. So I thought that was nice. So, Joe, do we have any questions?
Someone posts probably more of a statement or maybe a open-ended statement stating that he understands that Trump stopped travel to the United States from Europe by non-citizens, and then says, I don't think that he halted travel to Europe or return of U.S. citizens from Europe. So I'm not sure if you guys know whether that is the case or not.
Yeah, that is the way that I understand the president's action, that it is just as your caller statement indicates there.
Yeah, we were talking about that here in the office today as well. I wouldn't want to go to Europe and then have them close the borders completely. Not that I think that's going to happen, but why take the risk? But I think they'll always allow U.S. citizens back, but I don't know, a lot of people are canceling plans because they don't want to take the risk. Another question, the Federal Reserve made a major move today. Would you comment on that?
Okay, Bill, did you see what the Fed did today?
It was a big infusion of liquidity. It's of a piece with all the rest.
All right, so it's several $1 billion, I think.
Oh, it was huge.
Yeah, I'm sorry, listener. I've been sitting on my slides all day, and I saw something fly by that the Fed had put a large amount of liquidity into the system, but I apologize. I don't know the details behind that today.
And I think that's really it for questions.
Well, Joe, thanks for asking us. And as you can see, it's a lot of fun when we've got two people on here. I think it's good. It's more fun for us, and hopefully it's more fun for your listeners.
Yeah, I think so. I think everyone definitely learned something today.
Okay.
Does anyone else have questions before we begin?
Don't forget about the duffel bag now.
Ah, yes.
We don't have a lot of people, so somebody's going to get something.
Someone will, yes. All right, let me go through the names here, and we'll choose John Pong. I'm sorry, I don't know how to pronounce your name. Poeng. If you're interested in the duffel bag, if you can just in the questions post your full name and your address. Only I'll be able to see the question, what you type in. If you type that in, we will get that duffel bag out to you.
It's a really nice duffel bag. You want to get it.
John, are you there? Well, if John doesn't reply in the next 5 or 10 seconds, we might have to go to option number 2. All right, well, John going once, twice, that's gone. All right, how about Tiffany Hunt? Tiffany, are you there? Are you interested in a duffel bag? Well, looks like we're striking out today. Oh, there she is. Okay. All right, Tiffany, just type in your full name and address. We'll get that out to you. Again, I'll be the only one that can see that info. Guys, anything else that you want to add before we close it down for the afternoon?
I would just say go Nationals if they get to play. This thing may look way better by the time the regular baseball season starts. I hope it does.
I hope so.
Okay, thanks a lot, Joe.
All right, great. Thank you everyone for joining us. I really appreciate it. Hopefully we'll see you again at the next event. But until then, everyone stay safe. Have a good night. Bye-bye.